Thank you very much for having me today. So this is a paper about a model of post-2008 monetary policy, and this is joint work with Behzad Diba. And motivation for this paper is quite clear. Since the end of 2008, the Fed has been communicating its monetary policy in terms of two policy instruments. One is the interest rate on Banque reserves, what we call the IOR rate, interest on reserves rate, and the other is the size of its balance sheet. So what we do in the paper is to propose a very simple model in which the central bank does set these two policy instruments. Then looking backward in time, we show that the model can qualitatively account for some key observations about US inflation and US money market rates during the ZLB episode that lasted from 2008 to 2015. And I'm going to be clear about what exactly these key observations are in a minute. And then we are going to look forward in time, this time, to explore the model's implications for the pending normalization of monetary policy and the future operational framework of monetary policy. So by normalization here, I mean what happens to inflation and output when the central bank starts to raise its policy rate from zero or to reduce the size of its balance sheet, or what happens when the central bank announces that it plans to raise the policy rate from zero and reduce the size of the balance sheet. In the operational framework, we're going to consider basically two systems, the quarter system and the floor system. So in a nutshell, that's what we're doing in the paper. Now, about these key observations I was talking about, during the ZLB episode I was mentioning, inflation happened to be neither very low, nor very volatile, and nor very large. And here is a graph that illustrates this stylized fact. You have inflation in the US over the course of 20 years, and the gray area here corresponds to the ZLB episode I was talking about. And I mean, as you can see, inflation was not particularly high compared to before or after, or low or volatile during the ZLB episode. And to some people, I'm thinking more particularly of Cochrane here, which I'm citing. This long period of quiet inflation at near zero interest rates with large quantitative easing suggests that core monetary doctrines are wrong. What he has in mind here is that new Keynesian models tend to imply a large deflation and a large inflation volatility at the zero lower bound, and I'm going to explain how or why in a moment. While monetarist models tend to imply a large inflation following quantitative easing policies. To that, we may add an additional challenge to monetarist models, which is that T-bill rates drop below the IOR rate during this ZLB episode and even beyond, and that may suggest that money demand was satiated. And if money demand is satiated, then we lose the key link between money supply and prices that, lies at the core of the monetarist doctrine. So,
why do you say that models imply large inflation after QE? Monetarist models?
Well, at least if you double the money supply permanently in monetarist models, you're going to double the. Not necessarily.
Only if it's a helicopter drop, not if it's an open market operation. In fact, unpleasant arithmetic, Sergeant Wallace says the opposite.
So
that you have a deflation after an open market operation.
Okay, so here implicitly we're going to consider helicopter drops then.
Okay.
Okay, then about this second stylized fact I was talking about, the fact that the T-bill rate dropped below the IOR rate. Here is a graph that shows the two rates in equations with, again, the shaded area corresponding to the ZLB episode. And as you can see, the 3-month T-bill rate at least was below the IOR rate during this period. So what we do is to introduce a monetarist element, which is going to be bank reserves, into the basic new Keynesian model. So we'll have a model that is a blend, in a sense, of, that will have new Keynesian features and monetarist features. And the monetarist element is going to be the one that is going to buy us no significant deflation and little inflation volatility at the ZLB. But this monetarist element, raises other challenges I've just talked about. In particular, inflation following QE. So we're going to show or to illustrate that the model can account for no significant inflation following QE under two conditions, two key conditions. First, the demand for reserves is close to satiation to start with. And second, the monetary expansion is perceived as temporary. And then about the second challenge, faced by monetarist models, we're going to provide an extension of our benchmark model in which T-bills are going to provide liquidity services to non-bank financial institutions, and show that in this extension, the T-bill rate can be below the IR rate without requiring satiation of demand for reserves. So that's what we're going to do. Looking backward in time, try to account qualitatively for these facts. And then looking forward in time, we're going to show that the model always implies deflationary effects of monetary policy normalization. So deflationary effects of current and expected future IOR rate hikes and balance sheet contractions. And when I say always here, it means basically for any structural parameter value, any functional form for the production and utility functions. And then moving to the operational framework, we show that the corridor and the floor systems have substantially different implications in terms of equilibrium determinacy, in the sense that the condition for local equilibrium determinacy is weaker under the floor system. Basically, you don't need to satisfy the Taylor principle to ensure local determinacy. But if you don't satisfy it, as we show, you may have global equilibrium indeterminacy under the floor system. So that's it. The paper is related to a number of papers which I organize here around different themes. I'm going to be quick on that, but it has to do with papers about price level determination, papers about QE, about the new Keynesian puzzles and paradoxes, Neo-Furtian effects, and floor versus corridor systems. Now, I'm going to present the model in only 2 slides. So it's a very simple model. We have a representative household, which consists of workers and bankers. And here is the intertemporal utility function. Here, so beta discount factor, zeta here discount factor shock, U is consumption utility, V is the labor disutility function for workers, and VB, the labor disutility function for bankers. And the key assumption here that we make is that we assume that bankers use their own labor, so HBT, and also real reserves, MT, to produce loans according to this technology here. So this is, FB is an increasing function in the 2 arguments. Obviously, this is a shortcut to try and capture the role of reserves. In reality, reserves may be useful for banks to manage the liquidity of their own portfolio. Here, we try to capture that with this function, but because this is a shortcut, we want to impose as few assumptions as possible on the FB function. So we don't consider any specific functional form. We just make standard assumptions about the function. So we can invert this function FB and rewrite the banker's labor disutility, the last term here in this utility function, as a function capital gamma here of loans and real reserves. Positive function of loans, negative function of real reserves. And the first order conditions of the households optimization program imply that the interest rate on loans is higher than the interest rate on bonds. Why? Because loans are costly to originate. And the interest rate on bonds is higher than the interest rate on reserves. Why? Because reserves provide liquidity services, while bonds are used only as a store of value. Then firms are monopolistically competitive, owned by households. They use workers' labor to produce output, function F here. And we assume, second key assumption, so the first key assumption was here to generate a demand for reserves. The second one is here to generate a demand for loans in this economy. We assume that they have to borrow a fraction phi, which can be anything except 0, of their nominal wage bill in advance from banks, so at the interest rate on loans. Prices can be sticky. I say can because we're going to look at the model from different angles. So the log linearized model with sticky prices, but also the non-linear model with flexible prices. Theta being the degree of price stickiness. And in this model, the policymaker, which is the central bank, has two independent instruments: the interest rate on reserves, the IOR rate, and the quantity of nominal reserves. That's basically it for the model. So let me start with with trying to explain why or how the model can account qualitatively for these observations during the ZLB episode, starting with what the monetarist element in this model buys us, no significant deflation and little inflation volatility at the ZLB. And I'm starting with a local analysis. So basically, we assume that the two policy instruments are set exogenously around some constant values, in which case there is a unique steady state. And we log linearize the model around this unique steady state. What we get is, these three equations here. The first one is exactly the standard IS equation. The second one is a Phillips curve that looks very much like the standard New Keynesian Phillips curve, except for this term here in real reserves. So, sorry, hat variables denote log deviations from steady state. So why do we have this additional term here? Simply because as the stock of real reserves increase, this decreases banking costs. So this decreases firms' borrowing costs. And firms' borrowing costs are part of their marginal cost of production. So this decreases the marginal cost of production for firms, which is basically this term here driving the inflation in the Phillips curve. Last equation is simply the reserves market clearing condition that says that money supply, the supply of reserves is equal to the demand of reserves, which is a positive function of output through loans and a negative function of the spread between the interest rate on bonds and the interest rate on reserves, which is the opportunity cost of holding reserves. Now, if you combine these three equations here, you get a dynamic equation for the price level, PT, of that kind here with two non-predetermined variables. ZT is the exogenous driving term. It's a function of the discount factor shock, RT, and the two policy instruments. And we show that the roots of the characteristic polynomial corresponding to this dynamic equation are always three real numbers, which we call rho, omega 1, omega 2, such that rho is between 0 and 1, and omega 2, omega 1, omega 2 are above 1. Again, always for any structural parameter value, any functional form for the production and utility functions. So, of course, that implies that we get local equilibrium determinacy. Blanchard and Kahn's conditions are satisfied. So we can solve the model forward in time and get inflation, current inflation, pi t, as a function of expected future shocks, discount factor shocks and policy shocks with coefficients attached to this future shocks that are decreasing exponentially with the horizon of the shocks, K, right? That thanks to the fact that we have local determinacy under exogenous policy instruments, and in particular under an exogenous policy rate, just like at the ZLB. So if you consider a temporary ZLB episode that is caused by a large negative discount factor shock that cannot be fully offset by a cut in the IR rate, so the difference between IMT and RT is positive. So you replace and that lasts for cap T periods. You replace ZT plus K here by the corresponding value, and what you get is inflation at the start of this temporary ZLB episode, so pi 0, depends on the sum of these coefficients until date cap T. But because this is a geometric sum, and because omega 1, omega 2 are higher than 1, this sum converges to a finite value as cap T increases. So as the expected duration of the ZLB episode increases to infinity, inflation falls, but by less and less, and converges to a finite value. Contrast this with the New Keynesian model, the basic New Keynesian model, but this can be extended to standard New Keynesian models. What they do is to generate local equilibrium indeterminacy under a policy, an exogenous policy rate. So basically, in the basic New Keynesian model, you have two non-predetermined variables, but you have only one unstable eigenvalue and the other one is stable. So rho B is stable, omega B is unstable. When you do exactly the same experiment in this model, so there's temporary ZLB episode caused by a large negative discount factor shock, you also get the sum of these coefficients, but this time these coefficients are essentially increasing exponentially with the horizon of the shocks of K, with K. So as the expected duration of the ZLB episode increases, cap T increases, this sum here goes to infinity, and there is a minus sign here, so you've got more and more deflation, but that explodes, okay, exploding deflation. So that means that relatively to the basic New Keynesian model or to standard New Keynesian models, the model will typically imply a much smaller deflation during a temporary ZLB episode. Also, a much less volatile inflation, because in New Keynesian models, in standard New Keynesian models, because of this term here, which increases with the horizon K, any change in today's expectations about the values of future shocks, K periods ahead, any change is going to have a big impact on today's inflation, today's output. In our case, the coefficient here, for the horizon K is going to be small, so it's not going to be the case.
So here, what the quantity of money does is essentially drive a wedge between the rate on the bond and the rate on reserves.
Yeah, the quantity of real reserves. Yeah.
The quantity of the quantity of real reserves drives that wedge.
Yeah.
So does it do anything else in the rest of the system, or is just creating a spread between the rate in the Euler equation and the policy rate?
It is. I mean, behind this result of local determinacy, I will put it differently. I mean, I will say that if you think of this equation here,
yeah,
with on the left-hand side real reserves, yeah, which are nominal reserves minus the price level.
Yeah.
So nominal reserves here are exogenous in this exercise.
Okay.
We relax this assumption and find that the results are essentially unchanged. But when they are exogenous, you can think of, and IMT is exogenous too, because it's the ZLB.
Yeah.
You can think of that as what we call in a sense a shadow Vixelen rule, in the sense that it implies that the interest rate on bonds IT, yeah, depends on some exogenous terms, but also positively on output and crucially positively on the price level. Yep. So it is as if the central bank directly controlled the interest rates for bonds, which is not the case, it's a market rate, but as if it did set it as, following a shadow Vixenian rule that ensures local determinacy. So the fact that here we set money supply, quantity of nominal reserves exogenously, plays this role here to generate the local determinacy results. So I mean, it's implicit.
Let me put it this way. Can I write a version of the model where, say, I set m to 0, obtain an equilibrium, and can I find another identical equilibrium in terms of quantities and inflation with a different mix between money and the interest rate of reserve? So what I'm trying to say is, it seems I'm not sure if it's a redundant instrument or not.
If they play on the same wages, on the same margins.
Yeah.
Well, it's that I mean.
So by a redundant instrument, I mean, is it an instrument that expands the set of possible allocations, or the set of possible allocations induced by policy is exactly the same?
Well, here, I mean, to answer this question, we may want also to consider shocks, additional shocks. So if you look at these equilibrium conditions here, so in the last one, you've got the two instruments. So viewed from this perspective, I mean, playing on one and playing on the other can be equivalent. Mm-hmm. But here you only get the money supply. So if you have a cost push shocks here in the Phillips curve, you may want to kill it with the money supply and then offset the change in the money supply in the last equation with the IMT. So
it does affect the trade-off between output gap and inflation.
Yeah. So, but that has to be considered with additional shocks
I see. And one last question. Sorry, I'm interrupting too much. Where does the M term come in the Phillips curve? Where does it come from?
This one?
Yeah.
Well, it's the fact that as the stock of real reserves increase, the banking costs, the cost for extending loans for banks, decreases, and banking costs for banks correspond to borrowing costs for firms.
So it's a in the marginal cost.
Yeah, exactly. Okay, and then we endogenize nominal reserves. We consider a QE rule and show that the results are essentially unchanged. There is another reason or mechanism by which a model tends to generate no significant deflation at the ZLB, and this can be looked at when you do a global analysis of the model under flexible prices, because sticky prices are intractable in that case. So if you assume flexible prices, you forget about shocks, discount factor shocks. You consider a constant growth rate of reserves and a constant IRR rate here. So not only exogenous policy instruments, but constant ones. You get a dynamic equation that relates labor today with labor tomorrow. We get a unique constant inflation equilibrium, which corresponds to the unique steady state we had before under flexible prices, under sticky prices. And in that unique constant inflation equilibrium, inflation equals the growth rate of nominal reserves. What happens is that IM and mu pin down the level of real reserves, and because you have set the level of nominal reserves, this pins down the price level. So because we have a unique constant inflation steady state, we don't have any unintended deflationary ZLB steady state, a la Ben Habib and company. And at this unique steady state, inflation equals mu, the growth rate of nominal reserves. So provided that you set mu at least equal to 1, you won't have deflation at that steady state, okay? But we don't only have, in the set of equilibria, a constant inflation equilibrium. We may also get dynamic equilibria with below steady state inflation. That means the growth rate of inflation is lower than mu, the growth rate of nominal reserves. And that happens if and only if the interest on reserves, IM, is higher than the growth rate of nominal reserves, mu. So how or why does that happen? Well, you have to have in mind that in these equilibria, in which there is deflation relatively to the growth rate of reserves, the economy actually converges over time to satiation of demand for reserves, which means that the real returns on reserves, IM over inflation, converges over time to the real return on bonds, 1 over beta, so that gross inflation converges over time to this value, beta IM, and then the asymptotic growth rate of real reserves is mu over beta IM, and the transactionality condition says that this growth rate should be lower than 1 over beta. So it is satisfied if and only if IM is higher than mu, which is the condition I was talking about. Okay, now this is a result that is valid for any value for the interest rate on reserves, IM. Here, I'm going to use it later to consider, the properties of the floor system when IM is above 1. But here, I'm interested in the ZLB episode, so IM equals 1. And if IM equals 1, then you just need to set mu at least equal to 1 again to rule out these, multiple equilibria with deflation. And in this specific case, IM equals mu, that corresponds to the results, in Opsel-Rogoff or Ben-Habib and company. Okay, how much time do I have? 10? 15, okay, excellent, thanks. So that was about what the monetarist element in the model buys us. No significant deflation at the ZLB, no or little inflation volatility at the ZLB. But as I said, the monetarist element, raises some other challenges. One is inflation following QE. So what we do is to conduct a nonlinear numerical simulation of QE2 in our model with sticky prices. Actually, it's not only QE2. We're going to also consider 2 times QE2, so twice as much monetary expansion as during QE2, or 3 times or 4 times. To do that, we consider this time some functional forms, so isoelastic functional forms for the production and utility functions, and we calibrate the model to match some features of the US economy in November 2010 at the start of QE2. So we've played with many parameters, and actually there are only two parameters that really play an important role, which are whether we're close to satiation and the expected duration of the monetary expansion. But sorry, I forgot to say, the main result here is that we get very small inflationary effects of QE2 or 2 times or 3, 4 times QE2 under 2 conditions, so about these 2 key parameters. The demand for reserves should be close to satiation, meaning here that the interest rate on reserves should be close to the interest rate on bonds, which is mu over beta, the steady state. And the monetary expansion should be perceived as temporary. So I've talked already about the reason why it should be perceived as temporary here under implicit helicopter drops, which means that if it were expected to be permanent, you will have eventually the price level moving 1-for-1 with the money supply. So some substantial inflation along the way. And here, the fact that we need the demand for reserves to be close to satiation, well, when it is close to satiation, the marginal benefit of reserves is close to 0. The spread here between the interest rate on bonds and the interest rate on money is close to 0 as well. So when you have a large increase in the stock of nominal money, of nominal reserves, well, this can be, so this term here is going to increase a lot unless the price level increases itself a lot. But this increase in real reserves can be absorbed by a small drop in the spread between the interest rate on bonds and the interest rate on reserves. And this is indeed what we get here. So on the left panel, you have the assumption, which is the path for nominal reserves. The star line corresponds to QE2, one time QE2. So we move from 1 trillion of US dollars to 1.6 over the course of 3 quarters. And what we assume is that it stays there for almost 20 quarters before falling back to its initial level. So that's the assumption that it's temporary. Okay? And that's the solid line is 2 times, dashed line 3 times, dotted line 4 times QE2. That's the spread. So we assume here in this benchmark calibration that it's 10 basis points. It's hard to calibrate. Why? Because as I said, the T-bill rate was below the IOR rate during the ZLB episode. In our benchmark model, this cannot happen. We explain that in the extension I'm going to present by the fact that actually T-bill rates provide also liquidity services. But here in the model, IT is the rate on a bond that serves only as a pure store of value. So that's hard to measure in reality. So we take a stand here by saying the spread was 10 basis points at the start of QE2. And then what happens is that this spread falls from 10 to 6 under QE2 and falls more, of course, under 2 times, 3 times, 4 times QE2, but by less and less. These are the decreasing returns to QE in the model. Yeah, exactly. As we get closer and closer to satiation, starting with already a small spread. And inflation, the impact on inflation, is 18 basis points per annum under QE2, raises to 27 basis points, 32, 36, but less and less again, and at very small levels.
So what's the interest rate instrument doing in this exercise? Are you moving it or are you keeping it constant?
We're keeping constant, exactly. The only change here is the stock of nominal money. So as I said, in this benchmark calibration, 10 basis points for the spread and 5 years for the duration, the expected duration of the monetary expansion. If we doubled the spread, so to 20 basis points, or if we doubled the expected duration to 10 years, these figures here about inflation will roughly double. Okay, so still be reasonably small. Okay, now the second challenge faced by monetarist models, is the fact that the T-bill rate was below the IOR rate during the ZLB episode, so that may suggest satiation of demand for reserves. So to reconcile our model with this observation, we introduce government bonds that provide liquidity services into the model, that provide liquidity services to actually both banks and other financial institutions. The difference being that banks have access to the IOR rates, to bank reserves, while other financial institutions don't have access to reserves. So in practice, what we do is to assume that workers get utility from holding government bonds. That's this term here in the utility function. That is a shortcut again to capture the role of pension funds that hold government bonds on behalf of workers.
Just for clarification, this is still that they get liquidity services beyond what reserves gives.
In equilibrium.
It's very, if you state it that way, it says reasonable, but it's that the government bonds are giving you some liquidity that reserves don't. But reserves are the definition of liquidity, the means of payment. So what do you think this is that government bonds give me that reserves don't?
Well, the reason why in reality they value government bonds.
You said that the Z function is liquidity service.
Yeah.
You said bonds give me liquidity service. Reserves, not bonds, but reserves are the definition of liquidity.
Yeah, but the reason is that these financial institutions.
Irrelevant, no?
Yeah. So, for banks, for instance, banks also have access to bonds that, and these bonds provide liquidity to banks. We think that reserves, are more liquid than bonds. So we introduce this parameter eta here that can be 1 if they provide as much liquidity, but can be lower than 1 and up to 0, because banks have the choice between the two. But for the other financial institutions that don't have, it's just, I don't know, because these are still liquid instruments that, are useful for, facing any. No, that's.
It's a little peculiar, because it's relative to the liquid thing. But there's some benefit of bonds. You can place them as collateral, maybe that's fine.
Okay.
I mean, a simple answer, and that's how we, get that around in our econometric paper, is to assume that only banks get interest on reserves. So reserves on bonds have the same liquidity service for banking institutions. Banking institutions have interest rate on reserves. Non-banking institutions have no interest rate on reserves. So what that does is it basically makes banks sell all the T-bills outside the banking system and the rate.
Sure. I mean, I'm just starting a little definition of what that C captures. It captures something, and you should always start with Y.
Yeah. Well. Okay. We're having to think more about that. Okay. And then we show that this extended model with these liquid bonds has an equilibrium in which the IR rate is above the government bond yield. Because banks have access to the two, they prefer to hold only reserves for liquidity management. And because they hold only reserves, just like in the benchmark model, the equilibrium coincides with the one in the benchmark model in the sense that the variables that are common to the two models take the same inequilibrium value, which means that the extended model can account or does account for the negative spread between the two rates while preserving exactly the implications of the benchmark model for inflation at the ZLB. So that was about trying to account qualitatively for these key observations about US inflation and money market rates during the ZLB episode. And then we use the model, we explore the model's implications for the future, looking forward in time, and in particular for the normalization of monetary policy. So what we do here is, actually taking exactly this equation that we had, but replacing ZT plus K here, that depends on the two policy shocks by this function of the two policy shocks, and expressing in particular the stock of nominal reserves in this ZT as a function of the growth rate of nominal reserves, mu hat t, or the log deviation from steady state. Okay, and what we get is that this coefficient here is always negative. That one is always positive, again, for any parameter value functional form of the utility and production function, meaning that any current or expected future IOR rate hike, so increase in IMT plus K here, is going to have a negative effect on today's inflation. Any reduction in the future growth rate of nominal reserves is going to have a negative effect again on inflation. The reason why, as you increase the IOR rate, you increase the demand for real reserves, because the supply of nominal reserves is constant. That tends to decrease the price level to increase the stock of real reserves. And here, as you increase the nominal, the growth rate of nominal reserves, of course, this tends to increase the inflation rate. So the model implies, in particular, no neo-Fisherian effects, by which an increase in the policy rate would entail, in the short term, an increase in inflation. That's not the case here. So the second thing we look at about the properties of the model for the future is the operational framework for monetary policy. We consider in turn a Carter system that maintains a fixed spread between the two rates, the interest rate on bonds, the interest rate on reserves. And then you have a rule for any of these two rates, a Taylor rule. And a floor system in which, in the Carter system, you use your money instruments to maintain this spread fixed. And then you follow a rule for any of these two rates, for IMT, but of course then for IT as well. In the floor system, you leave your stock of money exogenous, and you have again a rule for the IOR rate. We show that under the Carter system, actually, we have a model that is isomorphic to the basic New Keynesian model. So in particular, we have the Taylor principle. But under the floor system, we know that when you set the IOR rate exogenously, you have determinacy, and we show that it's the case for any value, any non-negative value of the reaction of the IOR rate to inflation. So which means that you don't have the Taylor principle. You could, set your IOR rate exogenously and still get determinacy. We've talked about that. And then the rest, I'm not going to go into the details of that because of time constraints, but the rest of this presentation here says that actually when you react too little in the floor system, when you react too little to inflation, you get local determinacy, but you may get global indeterminacy. And I'm, again, not going to go into that. So the conclusion here is just a summary. We propose a very simple model in which the central bank sets the two instruments. We use it to look backwards in time and try to explain qualitatively some features of US inflation and money market rates during the ZLB episode, and then we look forward in time and explore the model's implications for the future. Thank you very much.
So thanks to the organizer for having me on the program and giving me the opportunity to discuss this paper. Before I start, the usual disclaimer, which in the particular case is really important. Okay, so to begin with, the paper is very nice, and I think it's a very ambitious paper. Lots of implications, both academic and policy. And my guess is that might be a game changer for people involved in the business of New Keynesian economics. So today, for lack of time, I focus on three key things: classic summary and the key takeaway results, so at least what I would take away from the paper as an applied guy involved in central banking. Also, a bunch of implications for the central banking business, alas, some of which were not presented by Olivier for lack of time. And a couple of comments. So, my own pitch of the paper, if you will. It's quite different from the authors. So, New Keynesian models are the workhorse of applied monetary economics, right? That's the starting point. Yet, these models are plagued by a bunch of interconnected pathologies, which, so to say, limit their usefulness. So there are multiple equilibria, there are crazy deflationary spirals at the ZLB, and of course the forward guidance puzzle. So to some extent, this paper tries to solve all these pathologies at once, hence ambitious. And the very surprising results is that it takes a very small deviation from the standard UK model to reach this. So Olivier presented the model in 2 slides. I'm gonna do that in 1 slide, normal. Okay, I'm gonna skip this as a matter of fact, but essentially keep in mind that there are just 2 guys showing up on top of the New Keynesian material. So there's this reduced form banking sector, which is embedded in the household program. and there's a loan in advance constraint on firms. And that's it. So the key results, under sticky prices and exogenous instruments, local determinacy always holds. Wow, that's pretty cool. So the liquidity trap is not going to be conducive to crazy deflationary spirals, and essentially that's because if IOR is stuck at the ZLB, that does not constrain the supply of reserves. And under flex prices and still exogenous instruments, you don't have the Benhabib, Schmidt-Grohe, Uribe unwelcome second equilibrium. As a matter of fact, you've got a single steady state allocation with inflation equal to the growth rate of reserves. And if by accident, because remember that in this particular setup, instruments are exogenous, so if by accident the CB sets the IOR at the ZLB, with the central bankers, anything can happen, then steady state deflation is ruled out minimum with a constant stock of nominal reserves. Okay, so basically adopting this setup could end once and for all the key controversies in the in the new Keynesian paradigm. Okay, so something that Olivier didn't have time to really delve into, but something that is really crucially important for a central bank economist, that's the current debate, floor versus channel system. Okay, so this is a US debate, but this is actually also, something that is closer to me, this is a European debate, which has not been really treated by the strategy review, but this is something that you should keep in mind. Okay, so the model under a corridor system is basically isomorphic to the standard New Keynesian model, except that this New Keynesian model has a single equilibrium and with determinacy under certain conditions. But the model under a floor system, you've got a very striking result. If you want to stabilize inflation close to its steady state value, you've got basically two options. Either you have scarce reserves or plenty of reserves, but there's no middle ground. And if you want to stretch the paper a little bit in the direction of Kashapenstein, you remember Kashapenstein, they say, okay, there are two instruments, so one is going to be used to gear inflation, and the other one is going to be used to basically address financial stability issues. Okay, so if you have this setup in mind, you would like possibly to have your balance sheet vary according to financial stability concerns. Okay, but if stabilizing inflation requires just the two extreme positions in your balance sheet, so scarce or very large, this somewhat limits the scope for the Kashapenstein approach. Okay, so now the nasty remarks. The paper focuses, at least section 5 of the paper focuses on simulating a QE. So QE is found to have a very small effect, a standard QE2 that buys you essentially 20 basis points of inflation, which is, labeled as small in the paper. So one key thing here is that QE has decreasing returns, which is something that is often overlooked in the literature, essentially because all the quantitative studies I know about QE use log linearized models, so it's difficult to have decreasing returns there. But is this really small? 20 basis points, is this small? And if so, according to which metric? My own metric is the position I was back in 2014 when I was involved in thinking about QE as an applied guy. And believe me, at that time, 20 basis points would have been a lot. I would have sold my soul for this. Okay, so, it really depends on the metric. But is this really a QE story in the paper? There are plenty of things missing from the picture to really have a story about QE. So I'm going to skip a little bit, I'm going to go faster, but essentially, in this setup, you've got one period financial instruments. So one period bonds, one period reserves, one period everything. So what about the risk maturity structure of the central bank balance sheet? You know, this is completely missing from the picture. And you know, from this standpoint, it's not really surprising that QE has so low, so small effects. I believe that the simulated path of QE is particularly unrealistic. So basically, you've got net asset purchases for 3 periods, then a reinvestment period for 15 periods, and then unwinding in 3 periods. Back in 2012, the Fed implemented what is called a maturity extension program. And that was with the intent of basically lengthening the average maturity of the portfolio so that the unwinding process on autopilot was supposed to take a very, very, very long time. So yes, QE is transitory, but highly persistent, highly persistent. So here, I think, you know, you should consider an alternative path for your QE simulation. Now, is what the paper claims to be a QE policy a QE policy? But for the reasons I was alluding to before, I don't think so. I think that what the paper is doing is in fact a simulation of a discount window or an LTRO. So that's like a liquidity injection. De facto, this really looks like an LTRO 3 years. Right, it's 3 years plus a couple of quarters. So is this to say that LTROs have a small effect? Once again, there are missing pieces in the paper to really address this question. You know, the stories about interbank market freeze. Why is it that interbank market freeze? Because there are, you know, notions of risks which are a little bit absent from the paper. That said, this is really a nice paper. It's highly attractive from the perspective, which is mine, of an applied macro guy working in a central bank. I think it's also very useful for thinking about the new operational framework. And as I said, this is going to be a very important debate in the next couple of quarters. And as you understood, I'm a little bit less convinced about the QE part, but the QE part is just a section. So congrats on a very nice paper. No, I'm going to keep this.
Thank you very much. Olivier, do you want to respond now, or should we collect questions first? Let's collect some questions first from the audience.
Yeah, so one parameter is phi, the fraction of the wage bill which is financed through loans, and you said you don't restrict the parameter value at all, or yeah, I was curious how model results change if this parameter is higher or lower.
May I take the liberty of the temporary chair to add that I didn't quite understand why that constraint is not always binding. It seems like there is not always binding, right? Other questions?
I would like to know more about the stability properties of the model. So I gather that what the introduction of reserves does. It essentially shifts the aggregate demand curve, right? So it enters as a cost push shock, as an endogenous cost push shock. So it must be that when you have instability in the original New Keynesian model, what happens here is that there's some behavior of that endogenous cost push shock that stabilizes the system again. So it would be nice to know exactly how, or have the intuition of why.
Philippe, let me give you the microphone.
Yeah, so I was wondering if you can say something in addition to the US case, if you can say something about the Japan experience and the mistake that they could have done, and could explain why they are stuck at, you know, low inflation and low interest rates environment.
Yeah, so I think I agree with all your points, in particular all the limitations you point to in the paper. Quickly speaking about the Kasch-Epstein argument, I don't know exactly what will happen in the model. So they say, if I understand correctly, that you could use the balance sheet to, the IR rate for macroeconomic stabilization purposes, and the size of the balance sheet to address some, or vice versa. Now, if you use here in what we do, the size of the balance sheet is exogenous. If you set it as a rule, that reacts to, I don't know, asset prices or whatever, that may of course change the determinacy properties of the model. So that will remain to be seen whether what will become of their proposal in this specific framework. Will it be a good idea or not? I don't know, but it's interesting to. I think it will be interesting to have a look. The QE effects is 20 basis points small. Yes, and I understand we may argue about that. And linked to that, there is the issue of how persistent. I fully agree that unwinding the monetary expansion in only 3 quarters is too quick. It's not realistic at all, because what we get when we double the expected duration, but with the same abrupt ending to it, what we get is just a doubling of inflation. I would expect a gradual decrease to not to raise inflation by that much. Sorry. Now there is a real issue here. We're still, with a very large balance sheet for central banks. So the benchmark calibration here is 5 years. That's that was a long time ago already. The end of these 5 years. So what we have in mind, the story we have in mind, is that at the start of the QE experiments, agents did not expect them to last for as long as what they did actually lasted. That will be our story, our interpretation, according to the model at least. And then in the process, money demand did increase due to some new regulation measures to get closer to money supply. And I'm thinking of the spike in money market rates in 2019, September 2019, as suggestive of the fact that that money demand did increase. Yeah.
On this, not for the US but for the euro area, you have access to the Bloomberg survey, in which market participants are asked about the expected length of QE. What you see is that initially they might have thought that QE not last long, but as QE was lasting longer and longer, they expected longer and longer QE maturities. So that's
yeah. That's very interesting. I didn't know there was this. I'm interested in this. Okay. Let's talk about that later. And then, I agree. We focus on the liability side. Of course, it's a very specific QE experiment. I fully agree. Very simplistic as well. In a sense, very gross. But thanks. A lot of thanks again for all those comments. Then the role of phi in the results. That's the parameter we're the most surprised to see. It did not have any significant change in the results. So it can be anything between 0 excluded and 1 included. It does not change the results. So basically, when you think of when you think of the Shadow-Vixelen rule I was showing on the slide coming from the money market rates, this phi appears in the coefficient of the price level in this rule. So it can move a lot, this coefficient, but what happens is that this term in the price level plays the same role as an error correction term in time series models in a sense, and that makes also the inflation stationary here, or the price level stationary. Sorry, and the size of it, may more or less postpone the dynamics, the return to the mean or whatever, but it does not change fundamentally the inflation results we had. So we tried, because there is no, it's not obvious to know how to calibrate this model, which we tried really, plenty of values. It did not change. We didn't try 10 to the power minus whatever, but true. Another parameter that I said, the degree of price stickiness also can play a role, but only if you make prices very flexible. Here we set it to 2/3, I think, 0.67. If we hesitated between 0.67 and 0.75. If we did set it to 0.75, the inflation impact will be even smaller. Now, if we do set it to 0.1, so very flexible prices, that the results will change. True, but within a reasonable change for this parameter, they don't, or they stay very modest. The constraint about the fraction of the wage bill to be financed by loans. Is it always binding? Yes, it is. There is no reason. Here in the model, in reality, obviously there may be, but no, that's a cost for firms that have to borrow this fraction, and it's always an equality. Reserves. Can nominal reserves, exogenous variations in nominal reserves can be seen as cost push shocks, if I understand correctly? Yes, to some extent, because they appear in the Phillips curve for the reason we mentioned. Now, it's real reserves that appear in this Phillips curve. So,
no, I meant not as exogenous shocks, just keeping the quantity of reserves constant. It seems that the system is modified so that if the canonical and the Keynesian model will tell you that you have a deflation at the zero lower bound, something is happening with the quantity of reserves that through the aggregate demand curve, acts like a movement in marginal costs that stabilizes the system.
Yes.
So I think that's a super important property because it's behind stability, so it must have some intuition, and that's what I was trying to.
Okay.
Because I do see it's a virtue that you're fixing that glitch in the Keynesian model. So it would be nice to know what's the economics behind that.
Yeah. Okay, I see. To be clearer about the mechanism.
Yeah. There's definitely a movement that as you have a deflationary pressure, something's happening with the marginal cost of the firm.
Yeah.
You must be jacking up or relaxing the funding cost of the firm. That changes marginal cost and moves aggregate demand in such a way that stabilizes the system. I think it's a very nice insight.
I see. So okay, so we have to dig that a bit further, I guess, to be clearer about that. Okay. Yeah, I guess this is, even with constant nominal reserves, because the price level falls along such a path, the real reserves are going to increase.
So that's reducing marginal costs. That's somehow playing a role stabilizing the system.
Okay, okay, thanks. Japan, the situation in Japan. So we didn't look carefully at Japan, but obviously there was a long period, a long ZLB episode as well. As far as I know, we did not observe, a very big deflation rate or a lot of inflation volatility, nor a surge in inflation following QE. So, at first sight, why not indeed try to apply the, to calibrate maybe the model to the Japanese economy and see what happens. That would be a good idea. Thank you very much.
Thank you.